Okay, so thanks very much for having me here. John Rogers pointed out that I'm not dressed appropriately for a university. I apologize for that. So I'm from the Federal Reserve Bank of New York. So this is actually the outside of the Federal Reserve Bank of New York. So whenever there are financial crises, there's a lot of movement in this building. There are like all the financial market participants who come to the New York Fed and try to figure out ways to solve financial crises. And so in between financial crises, we try to understand what gets us to these financial crises. So this paper is sort of like an effort to develop a theory of financial crisis that has very strong empirical counterparts. So you will see in the presentation, I will give you a model, but I will also confront the model with the data to sort of convince you that the model is capturing stylized facts that are important to understand financial crisis. And in particular, it's a theory about an intermediary leverage cycle. So I will explain exactly what I mean by that. So I'm from the New York Fed, so my views are not necessarily representative of the Federal Reserve's views. So what are sort of like key questions that we ask ourselves? So my job is sort of like half an academic and half a policymaker. And as a regulator, the kind of questions about systemic risk that we're asking is, you know, how does capital regulation affect the trade-off between the pricing of credit and the amount of systemic risk, right? So whenever the capital regime is tightened, you have market participants that tell you that tighter capital standards are costly for the pricing of credit. They have an impact on the supply of credit. And you know, we don't always have a theory to sort of like tell us whether there is such a trade-off. And so here's a theory where we do have a trade-off. And so we're going to look at this trade-off towards the end of the talk. A second question is about macroprudential policy. So there has been a lot of effort since the financial crisis to understand macroprudential policy and to work on macroprudential policy. But there has been very little work on macroprudential policy in equilibrium. So macroprudential policy is really about looking at the system as a whole and thinking about the equilibrium impact of prudential policy. So to think about that, you really need an equilibrium model. So this is a dynamic general equilibrium model where prudential policy is macroprudential policy sort of per definition. So that's another question that we can answer here. And then finally, we're going to look at the welfare implications of capital regulation. So there's a very large banking literature that is looking at capital regulation from a partial equilibrium point of view, and so they can't really make welfare statements. Whereas in this setting, we are going to be able to make welfare statements. So our theoretical framework sort of like answers these three types of questions, and you're going to see the answers that we're going to give to these questions throughout the presentation. So the approach that we're taking is to use a macroeconomic model with the financial sector, which is sort of like a model that has been studied in a number of papers in the recent years. And we are going to make one deviation from that literature. So there's one big difference, which is that the funding constraint or the sort of like leverage constraint of the intermediary is risk-based. Okay, so when risk is higher in the marketplace, when there's more risk, the funding constraint or the leverage constraint is tighter. Okay, so and this is sort of like when you look at how financial institutions are managed, this is exactly an assumption that is very realistic. So this is actually how financial institutions are managed. They have risk management systems so that when risk is going up, they have tighter leverage constraints. So the new part is to put this kind of leverage constraint, this kind of risk-based leverage constraint into a dynamic macroeconomic model. So that's the contribution of the paper. So there have been many papers of a dynamic macroeconomy with the financial sector, but none of these papers has looked at intermediaries that have these risk-based funding constraints. And so the assumption is empirically motivated from risk management constraints, and it's going to give rise to many empirical features that are borne out in the data. So in particular, there's sort of like three features that the model is going to have that other models don't have. So the first is that leverage of intermediary balance sheets is going to be pro-cyclical. So in booms, leverage is going to be high, and in busts, intermediaries are going to delever. So it's pro-cyclical leverage. And this is sort of like quite different from most of the other literature. So most of the existing literature has counter-cyclical leverage as opposed to pro-cyclical leverage. And we're going to look at the data in a moment as well, and that's a very strong feature of the data. A second stylized fact that the model is going to capture is that the share of intermediated credit is going to be pro-cyclical. Right, so firms can borrow from banks, or they can borrow in corporate bond markets. So there's sort of like market intermediated credit and intermediary intermediated, so there's market credit and financial intermediary intermediated credit. And so the share of the credit that is bank intermediated is going to be very pro-cyclical. And so the intuition is going to be that this risk-based capital constraint is going to be more binding for the intermediary in busts, so that the relative size of the banking sector is going to be smaller in busts and larger in booms. So capital markets are replacing the collapse of intermediary credit in bad times. And so this is something that is going to happen in the paper, and it's a very strong feature of the data as well. And then the third thing is that we will make the linkage between this intermediary leverage cycle and the pricing of risk. And so we're going to look at both the cross-section of the pricing of risk across assets, as well as the time series of pricing of risk. And so in the cross-section of the pricing of risk, what is going to be true in the model and in the data is that the price of risk of leverage is going to be positive. So securities that have stronger exposure, that co-vary more positively with intermediary leverage, are going to have higher risk premia. They have sort of like more systematic risk. And so this will arise endogenously in the model, and it's going to be a feature of the data as well. So I'm going to show you the data as well. And then there's the time series relationship between asset risk premia and intermediary leverage as well. And so here what's happening is that both in the model and in the real world, when leverage is high, this is sort of like pushing asset prices up, so expected returns are compressed. So in the boom, when asset prices are high, expected returns are compressed. This corresponds to states of the world where leverage is very high. And then, say, something bad happens, so there's an adverse shock, this is pushing up volatility, it's tightening this leverage constraint, and intermediaries are forced to sell, and this is when asset prices collapse and risk premia are going to widen. So we're going to have this time variation in expected returns which is associated with intermediary leverage. And this is exactly something that is going to be true in the data as well. So I will sort of like throughout the paper, I will talk through the mechanics of the model that are giving rise to these empirical predictions, and then I will show you evidence of these empirical predictions as well. And so what's sort of like another distinguishing feature of this model relative to much of the other literature is that we tie it very closely to the data. Whereas, you know, many other theories in this kind of literature is very much disconnected from the data. And we think that in order to understand financial crisis well, you really want to capture these asset pricing features. Now, in terms of policy, there are really two main results that that you want to keep in mind, or these are sort of like the main lessons, the main things that we learned from this kind of research. So the first thing is that there's a systemic risk-return trade-off. So what's a systemic risk return trade-off? So this is, what do we mean by a systemic risk return trade-off? So there's a risk return trade-off. So normally when you think about investing, investors face a risk return trade-off, right? They can choose to invest in riskier assets that in equilibrium somehow must have higher expected returns, per equilibrium arguments. Now, that's sort of like a partial equilibrium risk return trade-off. By a systemic risk return trade-off, what we have in mind is what a regulator would have in mind for in terms of regulating the economy as a whole. So when regulators in this model are tightening capital requirements, they're going to have two impacts on the equilibrium risk and the equilibrium pricing of risk in the economy. So the tightened capital requirements, on the one hand, this is making the intermediary sector safer. So there's less systemic risk, right? Because now intermediaries have more capital. But intermediaries also can take on less risk. So they can do less intermediation. So there's an impact on the pricing of risk. So regulators are going to have a trade-off between the amount of systemic risk in the economy and the price of credit intermediation. And so we'll come back to the systemic risk return trade-off at the very end of the presentation, where we sort of like look at optimal regulation within this framework. So in particular, what we're going to see is that there is an inversely U-shaped relationship between capital requirements and welfare. So when you start with a level of very low capital requirements, increasing capital requirements is unambiguously good, because the reduction in systemic risk effect is dominating the pricing of credit effect. So like the first order thing that you do is to lower systemic risk, and you only have a second order impact on the pricing of risk. But once you get to a state where you have fairly high capital requirements, then increasing capital requirements only has a second order effect on the amount of systemic risk, but it has a first order impact on the pricing of credit. Because basically you're constraining the ability of the intermediary sector to intermediate by increasing capital requirements more. And so this is a way of sort of like thinking about capital requirements from an equilibrium point of view. Now, there's a second takeaway from this model, which is that it gives rise to a volatility paradox. So the volatility paradox is that when measured volatility, like market volatility, market applied volatility, or just like measured realized volatility in the marketplace, when volatility is low, this is when this risk-based capital constraint on the intermediary is slack, and the intermediary can take lots of leverage. So this is when intermediaries have high risk appetite. It's sort of like endogenous risk appetite is high, so the pricing of risk is going to be compressed. Okay, so low volatility will be associated with compressed risk premia, like credit spreads are going to be very tight, and so like forward-looking market indicators, like indicators of tail risk, are going to be priced cheaply. So that when you look at credit spreads or the pricing of put options, you will say, oh, there's no risk, right? Because the pricing of risk is compressed. However, it's at those times that true systemic risk is the highest, because this is when leverage of intermediaries is high and the fragility of the intermediaries is high, so that if an adverse shock hits, they are going to be forced to delever, and there might be a systemic risk state that realizes. So in different words, is that the change of measure, the change of measure between the real world probabilities, the P probabilities, and the Q probabilities, that change of measure sort of like changes a lot over time. So the difference between P measures and Q measures are very large when you're in the boom. So that under Q, everything looks very benign, but under P, things look terrible. And so by looking at asset prices, you really want to make this change of measure, And the change of measure is a big deal because it's very nonlinear and it changes a lot over time. And it's going to change as a function of intermediary leverage. So we're going to look at the pricing kernel, and the pricing kernel is very nonlinear and it depends on intermediary leverage. Okay, so here's the economic structure. So there's a production sector and there's a household sector. And so the households can invest into three different types of assets. They can invest in intermediary liabilities, or they can invest directly into the capital stock. And there's a risk-free asset as well. Okay, so the portfolio allocation problem for intermediaries has three assets. For households has three assets, sorry. And then the intermediary basically holds the physical capital stock as well and issues intermediary liabilities. And those liabilities are going to be risky. So think about those liabilities as being the sum of deposits and short-term debt and long-term debt of intermediaries. Everything that isn't sort of like the common equity of the intermediary. And so these liabilities will be risky, i.e. the intermediary sometimes blows up and there's systemic risk. So we'll talk explicitly about the systemic risk state, and the stress of the intermediary is going to be endogenous in the model. And so these are, so A times KH, so A is the total productivity, and KH is the amount of capital that the households own. And then K, little k, is the amount of capital stock that intermediaries own. So A times K is actually going to be the dividend. So the production sector has a technology that is an AK technology. So the output will be A times K, and so little k is the amount of capital that the intermediary owns. So this is the dividend that producers give to the intermediaries. And A times KH is the dividend that the producers give to the households. Now, intermediaries, they can return some of these earnings. They can return some of these, retain some of these dividends, or they can pay them out. And so the payout of intermediaries to the households is in the form of coupons. So CB times BHT. So BHT is sort of like the amount of intermediary liabilities that the households own, and CB is a floating rate coupon. Okay? So the intermediary solves a dynamic problem where the intermediary sometimes retains more capital or sometimes reduces capital over time. So that's going to be endogenous in the model. Now, intermediaries are going to have two roles. So intermediaries, on the one hand, are going to absorb shocks for the households. So they have a risk-sharing ability, and they help the households to absorb the shocks in the economy. And the second role of the intermediary is that they generate new capital stock. So whenever new capital stock is generated, it's the intermediary that decides how much capital stock to generate. So that's sort of like you need a banker to generate new capital. Once the new capital is generated, it can be sold to either the households or the intermediaries.
In the intermediary, you're thinking that's a bank then?
Yeah, a bank, so it's both banks and dealers. It's sort of like consolidation of banks and dealers.
So when a bank makes a loan to a firm,
yeah.
I mean, the terms of that presumably would be a payment of interest rather than the receipt of dividends.
So here you would consolidate both the loans and the equity of the producers. So these are the total liabilities of the producers. So it would be consolidated both the loans and the equity. So the intermediary sector here would include both, well, the intermediary sector owns some equity as well of the producers. Right, so this is the total capital stock that is intermediated by intermediaries, or so it's the total liabilities of the production sector. So not just the debt liabilities, also the equity liabilities.
I mean, in practice, I mean, how would that split? I mean, so you would bank lending to firms.
So you could certainly split it. It would add sort of like a layer of default, because then the producers could default as well. And so you could certainly do that, and would be very interesting. It would make the model more complicated. Okay, so then the next thing is, so there are going to be two sources of deep shocks. So there will be shocks to the productive sector, so there will be productivity shocks, which are shocks to A, and there will be liquidity shocks, which are shocks to household preferences. And so intermediaries help to absorb both the productivity shocks and the liquidity shocks. Okay, so we'll see exactly how these shocks are specified on the next two slides.
Yes, can I ask you,
Yep.
why do you consider intermediate lending and direct lending simultaneously? What's the role of this assumption?
So it's for two reasons. So one, we see in practice that some credit is intermediated while other credit is directly granted. So in particular in the US, the corporate bond market is very large and it's important. And in particular, cyclically, we see that the share of intermediated credit is very pro-cyclical. So this is something that we feel is an important feature of the data and that we want to capture. So in other words, the directly intermediated credit is sort of like a substitute for bank intermediated credit, in particular in busts. So as I said, so the technology is an AK technology. So total output in the economy Y is just A times K, where A is total productivity and K is the capital stock. The capital stock is acquired endogenously, while productivity evolves exogenously. So log productivity has a drift A, a constant drift A, and has a Brownian term with homoscedastic shocks. So sigma A here is just like a constant. Okay, so fundamental shocks will be homoscedastic. And so so now you can see that productivity is going to have a trend. So the whole economy, all of the variables in the economy will be trending. And so in order to solve for a stationary solution, we sort of like scale everything by A. So the total price of capital is going to be PK times A, where A is a trending variable, but this PK is going to be a stationary variable. So we can solve for the dynamics of PK, and PK will be a stationary variable. So we'll refer to PK as the return as the price of capital, when in truth the price of capital is sort of like PK times A.
If you're dealing with productivity, why don't you deal also with the population growth? Because they're roughly on the same time scale.
Sure, yeah, sure.
But you
Yeah.
could fold
You
it.
could certainly do that, yeah. That's a good point, yeah. Absolutely. Yeah, so one of the aims of the model here is to write on a model that we can solve by hand. So what you can see actually, so unlike most models in this literature, this model you can solve by hand. Like this tonight, if you don't know what to do for a couple of hours, you can actually solve the whole model by hand. You don't need a computer. Now once you add in, so we can add in all kinds of stuff, but then we will need a computer. And we actually like the idea of being able to solve this by hand. Okay, so the second thing are household preferences. So households just have log preferences. They have an infinite horizon, and they have this Xi shock. So everything is standard except for these Xi shocks. So this is what we call liquidity preference shocks, and this is very much taken from the banking literature. So when you think of papers by Allen Gale or Diamond and Dybvig, these are sort of like the classic banking papers, and in those papers, households have shocks that makes them sort of like run to the bank, and so that's going to be a shock on the liability side of the intermediary sector. Right, so the classic macro shock is a productivity shock, which is a shock to the asset side of intermediary balance sheets, while the classic banking shock is a liquidity shock, which is a shock to the liability side of the banking sheet, of the intermediary's balance sheet. So we have both of these shocks. And so this shock psi also has Brownian increments. We allow it to be correlated with productivity. So rho psi A is the correlation between the productivity shock and the liquidity shock. And you can think of that, I mean, in the baseline case, you can think of that as 0. We leave it in here because it's going to be very instructive in a couple of slides. So I will refer back to that. And then you have these dz psi shocks. So dz psi is independent from dza, and these are homoscedastic as well. So the optimization of the households is to choose consumption, the amount of capital that they hold directly. So this is the direct intermediation. And then the amount of bank liabilities that they hold, subject to a dynamic budget constraint and subject to no shorting constraint. So we assume that the household can only be long capital and bank liabilities. They cannot be short, because here we talk about the household sector as a whole. So this is very standard. So now let's have a look at the intermediaries. Yes?
Is it bounded or
Xi now is not bound. It's just moving, and the whole economy is sort of like moving around.
negative?
It could be negative, yes. It can move around.
But in contrast to diamond diptych, your liquidity shock is a macro shock, right?
It's a macro shock, yes. It's not an idiosyncratic shock. Yeah. That's right. That's right. So in diamond there's some fraction of households that are getting a shock, not all of the households. Here it's all of the households that are getting a shock.
And you have a representative consumer for the whole economy. So.
We do have a representative consumer, because it's a macro model. So, so we do have heterogeneous agents because we have the bank and we have the households, but we don't differentiate within the household sector. Now you could imagine that there are many different types of households, so we don't do that here. But again, it's an extension that you could certainly work out. So now intermediaries, so we borrow from Brunnermeier. So Brunnermeier and Sannikov is sort of like one of the papers in this literature that is somewhat similar, but that doesn't have these risk-based capital constraints. Now we borrow from Brunnermeier and Sannikov that there are quadratic adjustment costs to investment, or put differently, whatever investment you put in, you only generate new capital as a function that is a concave function of that investment. And so this quadratic investment adjustment cost is sort of like the ultimate source of illiquidity in the model, right? So it's costly for intermediaries to invest, and so it's costly for them to be exactly at the optimal point of where they would want to be in terms of their capital stock. So it's a source it's a real adjustment cost of capital. And so intermediaries on the asset side of the balance sheet, they have the dollar value of capital, which is PK times A times K. Then the dollar value of liabilities, which is PB times A times B. And then the difference between assets and liabilities is net worth W. And so now comes the key assumption of the model, which is that there's a constraint, there's a risk-based capital constraint. So intermediary equity W has to be greater or equal to the total volatility of dollar assets. So this bracket here denotes the quadratic variation. So D times PK times A is the variance of the price of capital, and KT is the total amount of capital that the intermediary holds. So you can rewrite this constraint as a leverage constraint. So leverage theta, which is total assets divided by equity. So leverage is smaller or equal to something that is inversely proportional to like the volatility of the return to capital. So dP over P is the return to capital, and this is the quadratic variation of the return to capital. Okay? So it's the instantaneous volatility of capital. So why do we use that assumption? Well, that assumption actually is very close to the way that intermediaries are managed. So here we pulled a table from Goldman Sachs' annual report in 2011. And so the way that trading risk is managed is that they compute the risk on each of the trading desks. So for example, there's the risk on the rates desk, the equity desk, the commodities desk, and the currency desk. Then there's a diversification effect, so then you have a total amount of risk, total amount of trading risk. And basically that amount of trading risk is constrained. So each desk has a budget for how much risk they can take. And that risk is the way that capital is allocated. Okay? So this is how capital is allocated, by allocating valued risk across different desks and valued risk for the firm as a whole. So this is exactly this kind of constraint. So in particular, they look at the volatility of total assets and they allocate their equity capital accordingly. So note that intermediary equity is proportional to the valued risk of total assets. So this is not exactly a valued risk rule, right? So a valued risk rule would say that it's the valued risk of total equity which is proportional to equity, and that valued risk rule would generate a constant probability of default. But here the way it's done in practice and the way we do it in the paper is that the valued risk of total assets is proportional to equity, so then the probability of default is actually going to vary over time. Now, of course, this is a motivation from the market risk of intermediaries, but our theory wants to talk about bank intermediation as well, not just trading risk. And so what is sort of like the or what is the rationale for why that would be a good assumption for banks as well? And so here we have sort of like a kind of heuristic motivation. So here what we're plotting are the tightening standards from senior loan officer from the senior loan officer survey. So the Federal Reserve every quarter goes to commercial banks and asks the senior loan officers, how tight are your underwriting standards for credit? And what you see is that the tightness of these underwriting standards is very highly correlated with the level of market volatility. So when market volatility is higher, senior loan officers tend to tighten their underwriting standards. So even for the banking book, there seems to be a very tight link between sort of like the supply of credit to the economy and the amount of market volatility. So this is, again, sort of like, very closely linked to this constraint. Okay, then finally, so now this intermediary is going to be distressed from time to time. And this is what we call systemic risk, because there's going to be one representative intermediary. So there will be one representative household, one representative intermediary. And so whenever the intermediary is distressed, it is systemic because it's the whole intermediary sector. And so when intermediary capital W is below a certain boundary, then we say a systemic risk state has occurred. So tau d is the stopping time for such a systemic risk state. So this is the first time at which intermediary equity capital is below the default boundary. And so the default boundary, we assume that it grows with a dollar amount of total capital in the economy. So PK times A times K is the dollar amount of total capital in the economy, which you know is trending. And omega bar is sort of like an exogenous parameter. So you can imagine that omega bar depends on the kind of solvency regime that is instituted in different countries, right? So in Britain and in the US, you have different kinds of resolution regimes, you have different kinds of bankruptcy regimes. So this would shift around the omega bar here.
So here the balance sheet of the intermediary is endogenous.
It's endogenous.
So
Yeah.
why do you use the exogenous solvency constraint rather than just looking at the balance sheet?
So why? So in other words, why don't you put this equal to 0, right? So we don't put it equal to 0 because we have a representative financial sector. So we sort of think that 0 is not exactly the right number because there's probably financial distress before you hit 0. Because here we think about the system as a whole.
In other words, omega bar is a parameter determined by the regulator.
It's exogenous to the model, yes.
So you're going to change that omega bar.
So this could be changed in the model then. Yeah. And so then, as a result, now we can compute, so now we have the stopping time, which is when equity capital hits this boundary. And so we can compute the term structure of systemic risk. So this is telling you at every point in time, what is the conditional on today's state variables, what is the probability of hitting the systemic distress state, 1 year ahead or 2 years ahead or something like that. So this is sort of like something that as a regulator you would love to know. And so then what happens in distress? So we assume that sort of like, it's a kind of resolution regime, which is an instantaneous restructuring. So we assume that management sort of like changes loosely. I mean, we don't really have a management here, but sort of like loosely speaking, management changes. And the firm has to delever. And so they have to delever by writing down debt. Okay, so this is the resolution mechanism that we assume in the model. So they write down debt, and this is going to give a negative hit to the net worth of households because they write down debt. And so this delevers the intermediary, and then you instantaneously restart with a new level of intermediary equity that corresponds to this delevered amount of the intermediary.
Tobias,
Yeah.
can I ask you, when you stressed very much that you want to really match the data and the
Yeah.
Tyler's fact, but then in a deleveraging process in distress, isn't empirically the more important, what's going on in the first place, like shedding or selling of assets before writing down debt?
So assets are also sold. So they're writing down that, and there's a new equilibrium that is instantaneously computed that does correspond to an equilibrium where some assets are sold. So there are some fire sales here as well. But it does correspond. So you do have fire sales at the same time as you write down the debt, yes. So you have like sort of like instantaneously, you recompute a new equilibrium with a new demand and supply function that does correspond to or potentially corresponds to.
But if you can write down debt simultaneously, it smoothes a lot of the price impact of assets.
Sure. I agree with that, yes. So you could, so put differently, you could think of different resolution regimes. So this is one particular resolution regime. You could imagine different resolution regimes. So part of the reason why we use this one is that, again, it makes the model very tractable. Now, intermediaries, so I haven't told you yet what the objective is of intermediaries. So they have instantaneous mean variance preferences. So they're sort of short-termist. So they maximize ROE subject to a volatility penalty and subject to this value at risk constraint, the risk-based capital constraint. And so what they choose is the amount of leverage that they take and the amount of new capital that is generated, which is I, the amount of new investment in the economy. So that's the model. So now equilibrium is standard, so so households and intermediaries are price takers. And capital markets clear, the bond market clears, the risk-free debt market clears, and the goods market clears. Now, one assumption that we make is that intermediaries never consume. So intermediaries are sort of like machines. So think of intermediaries as just being in technology, not people. And that's going to simplify our welfare analysis, because for welfare we only have to worry about the households, not about the intermediaries. So when you look at the goods market constraint, total output, A times K, is allocated to either investment, IK times A, or consumption. There's no consumption of the banking sector. So how do we solve the model? So it turns out that that there are two state variables. There's the omega. So omega is the relative net worth of the intermediary sector. So it's like W over total amount of capital. So that's a very standard variable in heterogeneous agent models. So whenever you write down a heterogeneous agent model, you will have the relative share of net worth is like your typical state variable. So that's sort of like very generic to the setup. And papers in this literature always have this omega variable as a state variable. Now the contribution of our paper is to have an additional state variable, which is the leverage of the intermediary sector. So theta is an additional state variable relative to omega. And so you can think of that as, relative to other papers, we have two shocks. We have the productivity shock and the liquidity shock. And so as a result, you need two state variables to sort of span these two deep shocks. So the form of the solution, so I told you can solve the whole model by hand. So the way you solve it is that basically for all of the endogenous variables, for example for theta and omega, but then also for consumption, for the return to capital, you solve for the drifts and the volatilities. And so basically the drifts and volatilities are all functions of the two state variables theta and omega. So these are nonlinear functions that you can solve for in closed form. Now, I'm not going to show you the solutions because the solutions are very long. So you can solve it by hand, but they're very long formulas. So they, some of the solutions are sort of like a page or 2 pages long. So it's not that insightful that I show you the formulas. They're in the paper in the appendix. So instead what I will show you are simulations of the model confronted with the data. So I will show you a bunch of slides where there are simulations on the left-hand side and then the data is on the right-hand side. So like the first order thing is to look at the relationship between leverage and market volatility. So this is the data on the right-hand side. So here we just use the VIX, implied volatility of the equity market, as an indicator of contemporaneous volatility. And you can see that there's a negative relationship between volatility and leverage. So when volatility goes up, leverage goes down. And you have that in the data and you have that in the model.
So when you do lag, it's lag in which direction are you trying to?
Well, it's lag because, so in some sense, so we look at the leverage growth. And leverage growth is going to be a function of volatility, which is sort of like in the drift. So this is why we use the lag. So it's a 1/4 lag. So like
So it's previous VIX.
previous VIX, like the 1/4 lag of VIX. It's you have the relationship contemporaneously as well. We just want to
In the
stick to
model,
it.
and
Yeah.
when you look at the VAR picture, typically VAR estimators are backward-looking.
Yeah.
Right? They look at fluctuations, recent
Yeah.
fluctuations, whereas VIX and other indicators may be actually decoupled
Somewhat
so that
forward-looking.
when you're actually in the phase that you're interested in, so you're at
Yeah.
the brink of the. So maybe you can use actually a real line.
We can use realize, yeah. Okay, absolutely. Yeah. It will be a similar relationship. Yeah. We can do that. That's a very good point. Yeah. Yeah. And so here you see sort of like we do lots of simulations, and so you see that across these simulations, so what we plot is the median simulation, but you see a distribution across simulations. So the slope here, so this is the slope in the data, the regression slope in the data, and across the simulations you see different slopes. And so what we're plotting is the median outcome here. Now here are the balance sheets. So the right-hand side are data, and the left-hand side is the simulation of the model. So the first thing is that both in the data and in the model, we see very strong procyclicality. So debt, balance sheets are expanding because intermediary liabilities, intermediary debt is expanding. So intermediaries use debt to expand their balance sheets and contract their balance sheets. And so you have this very strong positive relationship between leverage growth and debt growth. Now, second thing, which is true in the data and in the model, is that equity, so this is the share of, so this is equity growth, so this is the omega variable, so this is the share of equity, of intermediary equity in total equity. So this turns out to be a very countercyclical variable. So in booms, actually, in booms, what firms are doing is to pay out a lot, whereas in busts, they return earnings or they issue shares. And so you see that both in the data and in the model. So equity is actually a very countercyclical variable. And then finally, the share of intermediated credit is very procyclical. So because in booms, volatility is going to be endogenously low, so that the leverage constraint of intermediaries is loose, so that endogenously they have large balance sheets, there's large credit intermediation, whereas in busts, volatility increases, the constraint tightens, and the relative size of intermediaries relative to the bond market sort of like collapses. Now, let's have a look at the household choice. So they have log utility, so because they have log utility, their consumption wealth ratio is constant. And this is very standard, except there's this convexity adjustment. This is like a Jensen inequality term, which is proportional to the liquidity, the volatility of the liquidity shock, sigma squared psi. Now, once you look at the portfolio choice of the household, so this is the fraction of household wealth invested in capital and fraction of household wealth invested in intermediary liabilities, pi b. So there are two components to the household portfolio choice. The first one is just mean variance component, because they have log utility, they don't have an intertemporal hedging demand. So their portfolio choice is to allocate relative to a generalized Sharpe ratio, where you have excess returns to capital divided by the variance covariance matrix of the price to capital and the price to intermediary liabilities. And then there's a hedging component. So this hedging demand is not an intertemporal hedging demand, it's an intratemporal hedging demand. And it's proportional to the volatility of psi, because the households know that they have these liquidity shocks, these psi shocks. They have a preference to hold assets that are a hedge against the liquidity shocks. And so you can see that this hedging demand, so even if rho psi A, so you remember rho psi A was the correlation between the productivity shock and the liquidity shock. So even if this thing is equal to 0, if this is 0, this becomes a vector of 0 and 1. So this thing here is a vector. This is not a fraction, it's a vector. So this is 0 and 1. So you have an intertemporal hedging demand even when the correlation between the productivity shock and the liquidity shock is 0. So in other words, the hedging demand of the households generates an endogenous correlation of asset returns between productivity shocks and liquidity shocks. So asset returns depend both on liquidity and productivity. And so then you can solve for the expected returns. So expected returns, expected excess returns, so this is the expected excess return to intermediary capital, productive capital, and this is the expected excess return to intermediary debt. So expected excess returns have three components. They compensate for own risk. So in the case of intermediary debt, so this is the volatility, total volatility of intermediary debt. they compensate for the correlation between intermediary debt and real capital in the economy. And then there's compensation for liquidity risk. Now, all of these covariances are endogenous, right? So these covariances are endogenous and they depend on the state variable of the economy. And so expected returns are going to vary over time. And in particular, when you simulate the model, you can simulate a relationship between leverage growth and the equity excess return. And this is sort of like a negative relationship, which is what I told you at the beginning in the first slide. So when in booms, volatility is endogenously low, this is when intermediaries can lever up, when they push up asset prices, and when expected returns are compressed. So high leverage forecasts low returns in the future. So this is saying that leverage is pro-cyclical relative to asset returns. And you can see that in the data, and you can see it in the model. So in particular in the data, so this is a 17% R square. So this is just running a forecasting regression of equity returns on lagged leverage growth, which has a quarterly R square of 17%, which is very large. Now, in order to look at the cross-section of asset prices, we can solve for the equilibrium pricing kernel. So this is sort of like the Radon-Nikodym derivative that you need to change between the P and the Q measure. And so the pricing kernel will depend on the deep shocks psi and A, but those are shocks we don't really observe. So what we do is to rotate the pricing kernel into observable variables. So we rotate it into shocks to output and shocks to leverage. And so basically, so this is the price of risk. This is just the output shock, and this is the leverage shock. So the leverage shock is a linear combination between the liquidity shock and the productivity shock, while the output shock only depends on productivity. Okay, so with these two observable variables, you span the deep variables that you cannot observe. And so now we can crank them through the model, and we can solve in closed form for the price of risk of leverage. So the price of risk of leverage tells you what is the equilibrium expected return for exposure to leverage risk. And so when you look at this expression, it turns out that this expression is always positive. So it varies over time. So the price of risk of leverage varies over time, but it's always positive. And so this is something that we showed in a different paper. So with different causes, we have a paper that just came out in the Journal of Finance where we show that leverage growth, intermediary leverage growth, is actually a very significant pricing factor for the cross-section of stock and bond returns. So here we'll use like standard sorted equity return, so portfolios of equity returns sorted by size and book to market and momentum, as well as maturity sorted bond portfolios. And you can see you have a very high cross-sectional R square of something like 71%. With a one-factor asset pricing model where the only pricing factor is intermediary leverage. So using intermediary leverage as a pricing factor is a good pricing model, and it always has a very significant positive price of risk. So this is exactly what the model here would tell you. So I have to speed up a little bit because I'm sort of like taking up a little bit more time than expected. Now, there's the price of risk of output as well. And so the price of risk of output is sigma A. So this is what you would get in a standard real business cycle model, like what Lucas used to write down. In the standard model, the price of risk of output is proportional to the volatility of productivity, right? That's very intuitive. But then there's a second term which is saying that the price of risk of output also has a term that is proportional to the volatility of liquidity risk. And so that's a term that turns out to fluctuate generically between positive and negative. So if you were to run a cross-sectional asset pricing test using output as a pricing factor, that would probably not be significant. And that turns out to be also something that is borne out in the data. So typically consumption CAPMs or production CAPMs are not significant in the data, and you have to do a lot of work to actually make them significant. Okay, so now, we went over the model, we went over the solution. Now we will look at distortions and amplifications, so at the policy implications. So the first thing is, so you remember the alpha coefficient was something, so the alpha coefficient told you how tight this valued risk constraint was. So when alpha is higher, the risk-based capital constraint is tighter. So you have a tighter capital regulation. And so what you can see is then as you tighten capital regulation, so you go from alpha equal to 2 to alpha equal to 4, you shift the whole term structure of systemic risk. So you shift systemic risk lower at every horizon in the future with tighter capital. So that's like the first order impact. Now, when you think about systemic risk, or what we call the distress probability, so this is the probability that the intermediary sector will be distressed a year in the future. So there's a volatility paradox, which is that when local volatility is low, forward-looking distress probability is high. And furthermore, so distress probability tends to be high when the price of risk of leverage is compressed, right? So when pricing of risk is compressed, and when volatility is low, this is when forward-looking risk is going up. So think about these CDS that AIG used to write in 04, 05, or 06, right? So they would write put options to insure the other financial intermediaries against the risk of distress in the subprime mortgage sector, and they sold those very cheaply. So if you were looking at the pricing of risk of housing risk in the US in 05, by looking at just asset prices, you would say, oh, there's no risk, it's very cheap. But actually, that sort of like, it's not quite the right conclusion, because there is, the change of measure between P and Q becomes very large in the boom. And so it's when pricing of risk is compressed, this is when the P likelihood, the real world probability of distress is actually increasing enormously. So doing adjustments, so sort of like having a heuristic where you say, oh, prices of risk are very compressed, so this must mean that forward-looking risk is low, is sort of like very wrong in this model. Let me skip that. These are sort of like some estimates of tail risk, but I'm running out of time, so I'm going to skip that. So this is perhaps the most important plot here. So this is plotting welfare. So this is household. So I told you that the intermediaries are not people in this world. They are sort of like a technology. So when we think about welfare, we only have to think about the households. And so as you're tightening capital requirements, so your alpha coefficient is increasing, you're increasing welfare a lot when you come from a low capital requirement. And this is because the first order impact is of tighter capital. It lowers systemic risk at every horizon in the future. But then as you're tightening capital requirements further, you also have an impact on the pricing of risk. And so because you're constraining intermediaries more, intermediaries have less ability to absorb shocks. And so that's a second order impact. And when you have sort of like a high level of capital requirements, that can actually dominate the first order impact of the lowering of systemic risk on household welfare. So now what is striking here is that the slope of the curve is much steeper on the left-hand side than on the right-hand side. So this tells you that you rather want to have too much capital than too little capital. Like too little capital is very, very costly, while too much capital is not too costly. So the black line corresponds to a benchmark case where you don't have a risk-based capital constraint, but you have a constant leverage constraint. And so that doesn't achieve quite as much welfare. So there's a risk return. So it's actually good in the model to allow the intermediaries to have a risk-based capital requirement as long as you make the risk-based capital requirement high enough. And so this is just showing you that actually in the data, here we are estimating a risk-return trade-off. And in the data, we also see a very strong risk-return trade-off over time, actually. So I'm not going to go into that because I don't have time. So in the last 2 minutes, I'm going to show you two extensions. So we have two follow-up papers on that that are so like expanding the papers in some directions. So you can expand the papers in other directions as well, as John had asked questions, and there was a question about population growth. So you can sort of like use this model to expand it in many different directions. So here we show you two directions that we have worked out already. So in one case, we look at both banks and a fund sector. So think about the fund sector as sort of like comprising hedge funds and mutual funds and pension funds and things like that. And so we use, for the fund sector, we use assumptions taken from a paper by he and Krishnamurthy. And so now we have the households and the producers, and we still have the bank intermediation, but then we also have fund intermediation. So there's no more direct credit intermediation. You have to be, if you invest in capital, you have to invest through a fund. So this is sort of like a little bit closer to the real world. And so the banks have still the same constraint. They have this kind of risk-based leverage constraint, while the funds now have what he and Krishnamurthy call a skin in the game constraint. So the funds basically, they try to get more assets under management, but how much assets under management they can get depends on the past performance. So when their past performance was low, they become constrained. And this is sort of like something that you observe in the mutual fund and in the hedge fund sector. And so let me just show you one plot from that paper. So here in this plot, we do the same thing. On the left-hand side is the simulated data, and the right-hand side is the empirical data, like the true data. And so this is a cross-correllogram between leverage in the bank sector and the fund sector and total financial sector asset growth. Okay, so when you're to the left here, this tells you that, so for example, this point here tells you that the bank sector, so the blue is bank sector leverage, and the red is the fund sector leverage. So this is telling you that banking sector leverage significantly predicts total asset growth in the financial sector at a lag of 5 quarters in the future. And so we find this here in the simulation as well. So basically, banking sector leverage predicts asset growth in the total financial sector positively. So that when you see the banking sector booming, you will predict that total credit growth is going to boom. Whereas when you see the banking sector collapse, this is very bad news for future credit growth. But the amazing thing here is that you don't see that for the fund sector. And that's, so you don't see it in the data or in the model. So the fund sector is acyclical, endogenously acyclical, while the banking sector is endogenously procyclical. And so the procyclicality of the banking sector here, the economic logic is very similar to, it's the same as what I told you in the previous paper. But the fund sector is acyclical. And this is in contrast to, so here in Krishnamurti they have a series of papers where they only use this fund sector and they don't have our procyclical banking sector. And when they only use the fund sector, they get counter-cyclical leverage. And so basically what we show is that by combining their fund sector with the banking sector, you get endogenously acyclical leverage for the fund sector, which is exactly what we see in the data. So this is one extension, and then the second extension is to look at liquidity requirements. So here we look at both capital requirements and liquidity requirements in equilibrium, and we try to sort out which one is the most important. So, and then we have a number of other extensions that we're sort of like thinking about, that we're either working on or we're thinking about either introducing stress tests in this world, right? Because at the moment, the leverage constraint is proportional to contemporaneous leverage, while a stress test would make the leverage constraint proportional to forward-looking volatility. Then we're thinking about time-varying capital policy, intermediation chains, as well as having both leverage in the household sector and intermediary leverage. And then you could add here leverage in the productive sector as well as the intermediary sector. So let me conclude. What I showed you is a dynamic general equilibrium model with financial intermediaries that generates a leverage cycle with endogenous amplification and endogenous systemic risk. And we think it's a good model because it maps into all these stylized facts. So it generates pro-cyclical intermediary leverage, a pro-cyclical share of intermediate credit. We generate this predictability of financial sector equity return from leverage growth, and we have a positive price of risk for leverage shocks. And so because the model features, captures all these empirical facts, we think it's a good conceptual basis towards financial stability policies. And so the main finding in terms of capital policy is that there's a systemic risk-return trade-off. So tightening capital policy has an impact on the level of systemic risk, and it also has an impact on the pricing of risk, on the cost of financial intermediation.
We are running a bit late, but if there's one question, we can take it before the break.
So the bank is providing, I guess, equity financing rather than debt to the firm.
It's a mixture, yeah. So you can think of it as a mixture of both.
I guess if you,
Yep.
so if you think of banks as actually holding like fully debt, that would potentially amplify results if firms were potentially defaulting rather than just losing equity.
That's right. That was exactly John's question.
Yeah.
So you would have like a double default potentially.
Just a comment. I think I was very interested in your final slide, number 32, where you showed this the relation between leverage and distress probability. So this is a very strong argument against the use of market-based indicators of systemic risk, right? Because this is very fashionable in
That's right.
many papers.
That's absolutely right. That's a caveat to market-based.
So it shows that they actually give you the wrong insight in this.
So it depends on whether you use them as market implied indicators,
Yes.
or
That's what I'm
so whether you do, that's
Thank you. Okay, so we have a 30-minute break until 11, and we come back.
Okay, good.